interest right now. So every year you will be paying back 200,000 in 5 years, 1 to 5 years. If you are on year three, this 2,000 will come to your current liability, and you will be paying back this 200,000 on year three as well. So we call this current portion of the long-term debt. Right, guys? Now, the current liabilities that must be estimated. The entry, okay, the treatment is simple. You pay the debt, it's going to be cash decrease, your liability decrease. Right? Simple. Long-term debt to cash, or current portion of long-term debt to cash. Simple. Because cash is decreased from the business. That's it. A simple one. No rocket science here. And now the current liabilities that must be estimated. It means the second part of current liability, which is we don't have any known amount, it is just the estimated amount. So number one is called the estimated warranty, and the other is contingent liability. For example, here, warranty period may extend for 90 days or up to a year. That's why it is current liability. But amount is not known. We don't know that how many pieces, they are coming into the business for warranty claim. We don't know that, right? In that case, we estimate. Okay, last year, 4 units came for like warranty. This year, we assume that only because our management is good, our production is good, we assume that only 2 will come. Turned out to be 10, customer they applied for warranty. So that's why their estimation is low distorted. So we don't know, anything can happen. This is ambiguity. So company must record expense in the same period that business record the sales revenue, which means if the product that you sell belongs to previous year and next year it is coming for warranty claim, so you will be recording the warranty expense in the year in which it is sold. Remember that one, because otherwise the expense recognition principle will not be matched. Right, guys? Similarly, the contingent liability, which means the potential liability which may occur in future due to past events. Maybe our company is in mountain area, or there earthquake comes, and we have normally, our glass breaks or door breaks, or will be having like some kind of repairment, or we are having a claim, a lawsuit against some firm. Maybe we win or maybe we lose. Right? If we lose, we have to pay this much amount, millions of dollars. For example, this famous case of Samsung and Apple. Apple claimed that they use our technology without our sorry guys, they claim that they use our technology without information, so they need to pay us $1 billion. So lawsuit came and turned out to be that the Samsung need to pay $6 billion to Apple company. So this kind of stuff. So how is the accounting? Accrue, disclose, neither, if unlikely. So if the chances are that it will occur, if more probability is that the liability occurred, it means you will pay, then you will record it. If the chances are that 50-50, you disclose it. You don't write it on your balance sheet. You just disclose it on the notes that this may occur. We have a lawsuit against, our competitor, and it may result in liability or may not. That's it. If the chances are unlikely, you ignore that one. So I have a illustration here. So let's read that one. So Black & Decker, which manufactures power tools, they made a sales of 100,000 subject to product warranties. The sales is 100,000. So question is silent, so it must be the credit sales, right? Which is the account receivable through sales. Assume that in past year between 2% to 4% of product products proved defective. It means 2 to 4% products they are defective and customer applied warranty expenses. So they estimated that 3% of the sales going to be requiring warranty services or replacement charges. So the warranty expense going to be, expense didn't happen. Remember that one. They estimated in advance. Did actually 3% they pay from their pocket? No. Entry would be warranty expense to expense, warranty expense payable. They estimated, customer didn't, if customer claimed, then it would be warranty expense to cash or something whatsoever. But since it is not, so we create liability. 3% will be asking from us that your product is defective and the worth of $3,000. So that's why we create liability. So this 3,000 will go to, in advance, will go to income statement, and we kept some liability in our balance sheet. If something happened, we decrease the liability according to our cash so that our expense recognition principle may not be disturbed. So this expense already went to the income statement, right? Now, what happened? Assume that all the defects add up to 2,800, right? And we created estimated liability for warranty 3,000. Now, claims are of $2,800. So simple, estimated warranty, and since we replaced that product, we didn't pay them the cash. Inventory decrease. Inventory decrease means credit, and liability decrease means debit. So our payable warranty liability going to be looking like this. So we created liability of 3,000. This actually happens. 200 is the balance, and we decrease our liability against inventory. We replace that one, so inventory decrease. If we pay them the cash, then it's going to be a cash here. Right, David, Sipade, Min, Arone, Misha, Jordan?
Yes.
I just have a question. It's not really related. When we account for inventory, do we use the sales price or do we use the production price?
The production price, not the sales price. Misha, because whenever there is inventory, there's going to be a cost of goods sold, which means the cost price is going to be, not the sale price. Right, Misha?
Okay. Mm-hmm.
Okay. So how we are going to record it? If the probability chances are high, we record it. If reasonably possible that we may lose or may not lose, then we just disclose it on the notes of the balance sheet. If chances are remote, then we ignore that one, right? So we also record it. If chances are there, we record it and also disclose it. So sorry guys, I just missed one point. That, for example, in this case, the chances are 3%. We also record it on balance sheet, and also we write it down on disclosure as a notes that we estimated 3% of warranty charges going to be there, and we record it on the balance sheet as well. Okay, so what is the concept checker if you understand the contingent liability? So which of the following is not true about a contingent liability? Not true. We just discussed that. So number A, depends on future outcome of the past expenses. This is true. Yes. Must be recorded if it is remote.
B, right? If
Yeah.
it's remote, it's not true.
Right? Must be disclosed if reasonably possible. Yes. So answer is B. Well done. Okay, that was our treatment of current liability. If you have any question, please do ask. If not, then we may end our discussion here. So up till now, we have covered the current liability. The next lecture is going to be the treatment of long-term liability. And over there, we'll talk about the bond structures and long-term debts. Okay, so no more questions?
Sir, when is the final?
Okay, we'll talk about after this lecture discussion. So with this lecture, any question?
I have one small question. What is an example of contingent liability, real life example?
For example, we sued our customer for disturbing us. This can be, or maybe we win or we may lose, or we sue our competitors that they use our logo illegally, or they just a little bit modified our logo so that customers are confused that it is our product or their product, and now the case is pending in the courts. We may win or we may not win, because so that's why we don't know.
Okay. Thank you, sir.
Right? Okay, any other question?
I don't have questions.
Okay, so I'm going to be stopping the recording. Okay, class, that is the end of our lecture. So stay safe, take care, bye-bye.